Good morning and welcome to the Mentor Board of Education meeting this wonderful Wednesday, October 28th. Mr. Wilson, please call the roll.
Mrs. Briner?
Here.
Ms. Jisling?
Present.
Ms. Miller?
Here.
Mr. Shaw? Mr. Tuttle?
Here. Please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay.
Mr. Wilson?
Well, thank you. The purpose of our meeting this morning is to present to you the fiscal projections for this current year, 15-16, through the 2019-2020 fiscal year. We have prepared a summary presentation for you that I'd like to walk through to support the document that we provided previous to the meeting. As you know, the theme this year for both our budget and fiscal year is sustaining our evolution, and we've highlighted some challenges and opportunities as we look at how do we sustain where we are. Some of our challenges include the economy that continues to reduce historically normal investment returns, costing us almost $2 million annually. A normal dynamic that happens because of the fundamental structure of funding public education in Ohio has begun to impact us. In 2012-2013, we began spending more money than we took in on an annual basis, drawing down on our reserves. An opportunity we have is to continue our discussions and possibly pursue a new property tax in 2016, a request to the community the first time since 2004. Another opportunity is we continue our evolution of teaching and learning and embrace more and more instructional technology. Most of the literature that I read in conversation with the superintendent and others is that eventually will lead to a less expensive form of providing teaching and learning. And our ongoing challenge at the state level is the policy that's driving more and more money away from us to charter schools, and something we continue to focus on. Part of our ability to sustain where we are, and we formalized this a couple years ago, is embracing and guiding ourselves on 5 fiscal management beliefs, and we always look at the context of 5 years when we make a fiscal decision, not can we afford it this year only. That we believe there's management options attached to every dollar we spend, and every time we have to make a spending decision, both Matt and I expect to discuss what are the options rather than default to we've always done it this way. Our focus obviously should be and has been on adding value to the teaching and learning to the extent that's possible, and we've done a lot of internal reallocation of funding strategies to support that. And we aggressively manage the largest expense categories: salaries, benefits, special ed, and facilities. Facilities being noteworthy in that this year, for the first time, we've shown the impact of the closing of Rice Elementary School. As difficult as it was, that's a major spend, and we'll touch on that a little bit later. And part of it, not in isolation of the other beliefs, is that quality is always cheaper in the long run. And we've seen examples in some districts in Northeast Ohio that have not embraced that, always go with the least expensive option, and it's that old notion of pay me now or pay me later, that we do try to take that long view and realize that quality does pay for itself. This is an old chart that dates back over a decade, but it's very important because we do consciously talk about delaying the need to request additional operating money, and we do that by carefully monitoring these key plans that we have in effect and try to make sure we're sensitive to all of those, and that has proven to be very effective. The Finance Committee, and to some extent the board, continues to encourage me to become a little less conservative and a little more moderate in my fiscal projections, formulas, and styles. Last year we presented quite a few refinements to the formulas and process. This year we've continued to make some refinements, particularly in the area of real estate tax assumptions. We've included $1,097,000 a year in tax increment finance payments that traditionally have not been certified by the county auditor and we've not picked up in the past, so we're recognizing there are $1 million of revenue every year. And we continue to refine how we compute salaries, both for faculty and staff, over the life of the fiscal projections. My goal, and you saw this for the first time last year, was to move us from that blue area to, as much as I don't like purple, that purple area, moderately conservative. And I had hoped to move the needle a little bit more in that direction this year, but in one sense it was very fortunate to us. We had a very good revenue year, and Matt and the administrative team continued to be very prudent in spending, and we had some very strong positive variances on both sides of revenues and expenses. But my goal is to move the needle. I don't want to get aggressive in assumptions or get the middle of the road, and I am very sensitive, and some of those changes in my formulas are to try to move that needle. So we'll continue to report on that. As with past years, there are 9 major assumptions that we make that drive this. There's probably 300 to 400 sub-assumptions that are developed to create the fiscal projections every year. The major ones, of course, is I have to make some prediction on inflationary costs to the various major expense categories of the district, and you'll see here that while the consumer price index is right around 2%, our market basket of goods is much different than a household in that we're a people business. And when I look at inflation trend rates in the Great Lakes region and nationally, believe this is a probably moderate assumption on inflation. We also assume that future state budgets will not reduce our funding subsidy beyond the enrollment adjustments that we have plugged in. This next one is an evolving assumption. Tangible personal property hold harmless payments will be phased out based on the currently adopted 2-year state budget, and I'll touch on that again in a moment. And that the 2013 enrollment study projections in the future will be accurate. No new federal or state unfunded mandates, and we've been fortunate the last couple years that there's been an ebb and flow of that, and anything could happen at the federal level. Some major discussions on changing Title I allocations and some other federal funding that would dump expenses back in our operating fund, but we're making the assumption that will not have a negative impact. Healthcare expenses we assume will increase 8% for inflation, 2% for national healthcare implementation. Historically, our special education expenses have increased at about 1.5 times the rate of assumed inflation. Energy costs are a growing cost to our budget. We assume no premium holidays from the Ohio Schools Council, and that the cost will escalate greater than the general inflation assumption. And finally, that the straight aid grant that now has been embraced and part of our budget and forecasting will occur as we've anticipated it will, and as the now that we're entering our second year of programming, how that will play out.
Dan?
Yes.
Could you just clarify why special ed goes up at 1.5 times the normal rate?
Part of it is the lack of market presence. When a student with special needs, and whether it's a visually impaired student or a student that's hearing impaired that needs an interpreter or some type of special service, there are very few of those providers that will work in the education arena. And because of the lack of competition, we're at their mercy on pricing, and we see that. There's also, for whatever reason, whether medicine's allowing better diagnosis of the special needs that students have, it seems like we're getting more needs to be served in students that are requiring additional services we haven't had, and that seems to be evolving. I just read a report in Ed Week yesterday about type 1 diabetes and the additional challenges that there's been a 23% growth in type 1 diabetic students in the last decade that require significant medical attention. So it's a combination of lack of market presence and more complex needs of our students.
Thanks.
The chart continues to be, and I apologize for the fine print, but it is in there. The bottom right-hand corner is the number I'll focus on. Over the life of these fiscal projections, going back to 2004 is our base year, 4 tax policy laws that were enacted in the state of Ohio have caused us to lose $59,938,583, or so we assume over the life of the projections. Major revenue issue. In fact, when we get to the bottom line page, you'll see our projected deficit on June 30th, 2020 is $58 million. Had not these 4 tax policy changes that happened in 2004, we would have balanced budgets through 2020. So again, when we talk about legislative mandates and changes, our core issue is declining revenues much more so than being able to manage our expenses. On here, again, I know the numbers are a little bit red, but what we're presenting are year-over-year changes in revenues for the district, and all you have to do is kind of look at how many red numbers are up there, which means a decline in revenue. And this, again, is because of those 4 tax policy changes and some funding policy changes by the Department of Education. But more than half of the years have experienced actual or projected decline in year-over-year revenue. One of our key dynamics is how many students do we anticipate educating. That drives staffing level and other programming considerations. The enrollment study that was the 3rd one done in my time in Mentor shows that we're beginning to bottom out when we look at number of graduating seniors to number of incoming kindergarten students. They're beginning to equalize a little bit, and you'll see in these numbers a few years ago the year-over-year change would have been 200 or more students. We're now seeing 81, and then the last year projected 50 students. So we do believe we're reaching kind of the equalizing point as far as students will be around $7,000, or 7,000 students, I'm sorry, going forward. And of course that then translates into staffing, and working very closely with Matt, we reflect staffing adjustments primarily driven going forward on the change in number of students we educate. 2015-2016 was an extraordinary year. Reflects the closing of Dale R. Rice Elementary School, in addition to significant changes as a result of implementing straight A grant programming. But going forward, you'll see that in 18, 19, 19, 20, we only expect to reduce 1 teacher, again, as students begin to stabilize. This is one of my refinements on the salary piece. We had 2 dynamics going on. The state teachers' retirement system had significant reductions in pension benefits for those that did not retire by June 30th of 2015. And demographically, over the last 10 years, we had, aging's probably not the word, a more senior faculty that was approaching retirement time, and we've now seen we've become much younger as a faculty, and that hard deadline and incentive to retire, the retirement system has come and gone. Last year, we had almost 30 retirements, and we were in the mid-20s in the preceding years. We dropped that back to 12, 12, 10, and 10, which represents about a 1.5% retirement rate going forward. Again, I know the numbers are small here, but it is in our book. One of the key benchmarkings that we do as we're adjusting staff to enrollment changes, to the number of buildings we operate, to the straight A grant programs, a key dynamic is students per teacher. That's often called the student-teacher ratio. This is not a formula that's indicative of what you're going to see when you walk in a building and walk in any individual classroom, but it's an average across the district, total number of faculty divided by total number of students. In 1999-2000, it's not on this chart, we had one faculty member for every 15.1 students. By the end of the fiscal projections, we believe we'll have one faculty member for every 14.82 students, actually a smaller pupil-teacher ratio. And in this chart from 2011-12, when we go look back 3 years through the forecast, is 14.84 to 14.82. So when we've seen all this adjustment in staffing, it's not been at the expense of let's just make classrooms bigger, or let's put more expectations on faculty to be responsible for more students. So this is a key guide for us. And we also benchmark this to state averages and federal averages. Unfortunately, those averages lag by 3 or 4 years as far as how current that data is. Statewide, there's one faculty member for every 18.47 students, and at the federal level, one faculty member for every 16.3 students. So compared to the state and federal averages, we have a better ratio as far as number of students to faculty member than those benchmarks. On the expense side, again, numbers are small, and I just ask you to look at red, which would mean a year-over-year decrease in expenses. That's only happened twice, 2004, 2005, when we were in fiscal crisis, and in 2009, 2010. Otherwise, we're seeing increases, but most significantly, I'll show on this next chart, 3 different numbers here. I think our Board of Education and the administration were very sensitive to the challenges of our community created by the Great Recession, and we, like every household, saw a need to be extra frugal, not just prudent, but frugal in our use of monies, and we slowed the year-over-year growth to 2.15%. In the post-recession years and projected through the projected year 2019-20, we're assuming a 3.2% growth rate, which is still very prudent when you look at the national norms for educational inflation, taking our market basket that's unique to K-12 education. The year-over-year growth is closer to 5%. So we believe we're still prudent in our use of money. We were very sensitive to those Great Recession years, but are slowly returning to a little bit more normal growth pattern. I mentioned a moment ago that for the first time we've rolled in the impact of closing Dale R. Rice, and one of those 5 fiscal beliefs is you managed our largest expense categories. This shows that over the 5 years of these fiscal projections, the cost reductions as a result of closing that elementary, as difficult as it was, will produce $3,914,000 of savings. So a very significant positive impact on our fiscal projections. And that leads to some very good news. For the first time, we're predicting a balanced budget for 2017-2018. And this now means that the 2004 emergency levy, which was the last time we asked the community for new money, has now funded, based on our assumptions, 14 fiscal years. Remarkable in a state where the average is 4 years. The bottom line here for us again, and I know it's small up on the screen, but the bottom right-hand corner you see 2 red numbers. This is simply beginning cash, total income, total expenses, ending cash. And the most important thing is we're predicting a deficit of $24,680,000 in 2018-19, and that compounds out to a deficit of $58,347,000 in 2019-2020. Well, you wonder, how is that? And again, I'll go back to beginning in 2012, 2013, we began to spend more money than we take in, requiring us to spend down our reserves. This year, even with the update, with the benefit of a quarter of the fiscal year completed, we're assuming we're going to spend $5 million more than we take in. Next year, that goes to $16 million more than we take in. So again, we have a revenue challenge more so than an expense challenge. Having said all that, one of the remarkable things from my view as a non-educator is I sometimes, I like numbers, and I'm not intimidated by a $100 million number or a $500 million that are forecasted to be spent over the 5 years. But I think for many people, they get lost in numbers that big. And so I wanted to break this down to a smaller unit of analysis and something that maybe everybody could relate to. And what we show here is our average cost per day and our average cost per hour to educate a student. And you'll see we spend $74.60 a day to provide the high-quality education offered here in our school district, and that equals $9.95 an hour. When I look at the resident share, if I take the amount of taxes paid net of the homestead and rollback payments compared to total spending, a homeowner is paying $30.40 a day or $4.05 an hour. Now, it's been a while since I've had to hire a babysitter, but I remember paying a babysitter when my boys were little, heck of a lot more than $4 an hour, just to make sure they were safe, and that didn't include any of the quality instruction we provide. So when we get down to a smaller unit of analysis, to me as a non-educator, this is very impressive, what we're able to do, being very prudent with our budget. This is what I refer to every year as my grade card, and going back to that arrow chart where we want to move from conservative to moderate. I'm averaging 96.1% accuracy on revenue and 96% accuracy on expense. Our goal is to get to 98%, and I'm continuing to refine some of our formulas to help us get there. And again, I caution the board from simply saying it's automatic, we're assured of getting more money and spending less than we do. Every one of my assumptions, I believe, are reasonable and based on current information, and it takes something beyond the norm for us to either not spend the money or to receive more money. So we always hope for that positive variance, but I'd be very reluctant to guarantee it. I'll sound a little bit like E.F. Futton now. Past performance is not the best indicator of future success. Just because we've had positive variances doesn't mean they'll automatically occur in the future. We always look at some key financial indicators, and one of those is to track trend lines of number of students we have, the number of overall employees, they include faculty and staff. And you'll see since 2003, 2004, our student populations declined 26.5%. Our overall employee base has declined 31.3%. So the trend lines are tracking each other, and actually the staffing has been reduced a little bit greater rate, but that's important. As a footnote, when I joined the district, the lines were going in separate directions. We had declining students and increasing staff numbers, so very bad key financial indicator, and we've righted that. Another is a traditional benchmark of how much do we spend on salaries and benefits. Most people will embrace that 80 to 85% of the operating budget's the safety range to be structurally sound from a budget standpoint. There are some that will say it's 75 to 85%. In either case, through fiscal prudence and tracking number of students to number of faculty and staff, you'll see we've decreased from 84.9%, the high end of that safety range in 05-06, to this year 79.67%, and then creeping up very slightly to 80.43% the last year projected. So from a structural standpoint, the budget and the assumed budgets are structurally very strong.
Can I just say something about that?
Yes.
That slide is really indicative, I think, of the direction we're trying to go into. And anytime you can get below 85, my experience has been that that's much better for the kids. So I
Yes.
just wanted to appreciate that slide a little bit.
And if I can add, anytime we're around 80, it makes me happy. Nothing against our staff, but it just makes me feel a little more comfortable.
Yes.
So kudos to those that have made that happen. Thank you.
The old school finance 101 chart, another key financial indicator is you track which year you begin what some people call deficit spending, where you spend more than you take in. The blue arrow indicates the first time that occurred was 2012, 2013. And you'll see revenues are declining, which is our hugest challenge, and expenses are growing. And if you look at the three slopes of the red line, before the major reset in 2004, 2005, just kind of project an arrow going straight up. After the reset, that second line that's going up is not quite as steep, but almost as steep. And then the third line going up, now that we've gotten through the Great Recession and we're returning to more normal growth patterns for K-12 education, a little steeper line. So again, that would be what you would see in almost every district nationally. What you don't see in Ohio, it used to be revenues were flat, but we've seen a gradual decline and now a steepening decline because of the tangible personal property. I'll touch on that again just when we wrap up. Well, how does that work? At home, if we spend more than we take in, that's not a good thing, and the only way you make that work is you have to go to your savings account, or what we call our reserves. And you'll see in 2012, 2013, we had to use $2 million of our reserve. We predict this year we'll have to use $5.4 million of our reserve, and the reserve will be totally depleted by the end of 2017, 2018. The thing with the reserve, just like a savings account at home, you can only spend it once. Once you take money out, it's gone. You can't keep using it year after year. So our fiscal prudence, our fiscal conservatism has said, let's bank any positive variances we have on revenue expenses, knowing that we're spending more than we take in, and try to sustain again our evolution by using these accumulated reserves to soften major cuts to programming.
Dan?
Yes.
Before we move on, could we go back to that last slide? We've seen this slide a lot over the years with some red as we project out into the future. And to the credit to the board, the administration, the staff, everyone here in the district, we've always seemed to find a way to erase that and turn that into the black. My concern is, or my question is, are we running out of ways to be able to do that? I mean, I don't want people to think that, well, the red numbers don't really mean anything, because they always find a way to get it done.
Yes.
We've been able to do that through one-time monies and some cost reduction and those types of things, but are we kind of getting to a point where there aren't going to be any other ways to erase that red or get that to switch?
Yes, you're exactly right. Many opportunities to reduce spending only occur once. For instance, we closed an elementary school. It's going to save us $3.9 million. We can only close that school one time. We can't say we'll just keep closing schools. That was enrollment driven. We leveraged the marketplace and bid our health care insurance and prescription drug insurance and reduce costs. And yes, we can go back into the market. We try to go once every 5-year period to test the marketplace to do that, but you can't do it every year. So as we've adjusted staffing to number of students, as we've tried to pursue every savings, we've not only done the easy stuff, we've done the moderately hard stuff now, and we are running out of opportunities to save money. On the revenue side, again, historically, I've been conservative in the projections. You can say, well, there's always a little more money, so that'll take care of it. But the dynamics at the state level with the current state budget resuming the phase out of tangible personal property that costs us $2 million a year, well, that's 2% of our budget. So even if I hit my 98% goal on revenue and that produced another $2 million, it just offsets that loss of $2 million. It's not a true gain anymore. So while the community could say you've always somehow managed to deal with it, just do what you've been doing, you're exactly right. We've kind of run out of the opportunities there. And again, going back to our 5 fiscal beliefs, one of them is every dollar should support teaching and learning. We've gone to some pretty sophisticated and innovative ways of reallocating resources to support programming and reduce operational costs. But you can only do some of those things one time. So yes, we are kind of running out of opportunities to make that go away.
Thank you.
This is a chart I can't explain, but I'm fascinated by it. And again, I apologize for the small numbers a little bit, but every year in the budget book and the forecast book, we show you the total number of K-12 students that reside in the school district, how many are enrolled in our school district, how many are enrolled in private schools, and then take a percentage of that. Going back to 1998-99, we had 16.3% of all school-age students opted for a private school or a charter school. That grew to over 19% in 2006, 2007. Quite frankly, I expected a significant dip during the Great Recession as people were challenged with the economy and the affordability of other options, but it declined a little bit from the 19% to 17.4%, but we began to see something pretty remarkable in 2011, 2012, a decline to 13%, 12.4, 13.7, 13.1%. And I don't fully understand it. My guess is if you ask Matt, what do you think of that? He's going to say that's really good news. People value what we can provide here in our school district and realize the best educational option for their student is to be with us. If you ask me, I'm going to say this is really bad news because every one of those students that come back don't bring any revenue with them. They only bring expense. That's the nature of school funding in Ohio. So there's kind of good news and bad news. Part of the drive for our evolution is to be the provider of preference, if you will, as we're moving forward with the evolution of education in our country and in our region and state. And so for whatever reason, this is pretty interesting stuff. Financially, it adds to our challenge that as we're having more students come back into the school district, they don't bring new revenues with them, so we've got to figure out some way to make that work. So I just threw it in because I'm fascinated by it, and it kind of shows the two sides of the equation. Before I go to the last slide, all my assumptions and all my work are kind of based on to the extent that we get through the month of August and halfway through September when I start the forecasting, I have almost a quarter of the fiscal year that I can update my information and be a little more current on the data I use. But again, I'm trying to predict what's going to happen on June 30th of 2020. And all I know for sure is I'm not going to be right because things change. It's just how close am I to being right. Well, one of the most current events going on now, in fact, current as of 5 o'clock yesterday, is Senate Bill 206 has now Senate Bill 208 passed the House, concurring with the Senate with minor changes. It went back to be reconciled. The Senate accepted the House changes. It's now going to go to the governor for signature, and he'll have 10 days to decide to sign it or veto it. But what this legislation did, it primarily started as a fix of small business tax, some glitches in technical areas that negatively hurt small businesses that was in the budget bill, but became the vehicle for trying to help the almost 100 districts in the state that were negatively impacted by the resumption of the tangible personal property phase-out. We're one of those districts. We're one of the ones affected most dramatically, and this would continue to supplement for 2016, 2017, the second year of the budget, where the budget bill said after 1 year, the phase-out continues and there's no supplemental payment. This legislation would provide $1,700,000 of additional funding to soften that decline, and then perhaps another $1 million in 17-18. We're still waiting for detailed simulations. So the good news is there's a potential for another $3 million of revenue because of a legislative change that's occurring as we're sitting here. The bad news is that deficit number that we're looking at is 24 million and 58 million. So it's not enough to get rid of that red number, even though there's something positive that might be happening there. So we'll provide you updates to it, but the nature of our fiscal projections are we have to pick a point in time and try to move forward from there and then be sensitive to changes that occur. We'll pick this up when we do our update next May in the hope that indeed it is good news. So that's kind of breaking development that had I known this 3 weeks ago, I probably would have put it inside the booklet, but given the timing, it's just not there. And finally, as the board knows, you appoint a Citizens Financial Advisory Committee that's business leaders in our community with a knowledge of finance to monitor the development of both the budget and the fiscal projections, and also bring best practice recommendations to the school district for fiscal management. And their job is to get deeper into the assumptions, to judge reasonableness, judge structural soundness of the work that I present to you, and then make a recommendation to you from them on their opinions on the fiscal projections. We met on Monday afternoon, and the committee consensus was, unanimous consensus was to recommend the Board of Education approve the fiscal projections. So with that, I've walked you through. You have the booklet. Be happy to answer any questions. And this will be a reference document as we go forward and talk about future revenue needs here in the next few weeks.
Call for a motion.
So moved.
Second.
Is that Jenny? Okay.
Questions, comments? Please call the roll, Mr. Wilson.
Ms. Jisling?
Yes.
Mr. Shaw?
Yes.
Mrs. Briner?
Yes.
Ms. Miller?
Yes.
Mr. Tuttle?
Yes.
We need a motion for executive session.
Motion for executive session.
So moved. Second?
Executive session to review potential sale at auction of the school district property. Do you anticipate a vote after?
No.
No, we do not anticipate a vote, and when we return.
Ms. Miller?
Please call the roll.
Yes.
Mrs. Briner?
Yes.
Ms. Jisling?
Yes.
Mr. Shaw?
Yes.
Mr. Tuttle?
Yes.
I think we're meeting in your office?
Yes.
Great.